I think the consumer is broken. And I think once you have an official recession, that's when their real fear comes, no matter who's in the election. And they say, I might lose my job. I can't afford to move. I can't let go of a down payment and closing costs. And I think it's going to be a while before they really start coming back in droves. That's just my prediction. I hope I'm wrong, Michael, but
Mm.
I think the consumer's broken.
Alrighty, folks, as promised, we are once again going live inside our school community of One Rental at a Time with the one and only Anna Kelly. Anna, we've been doing this together for 5 years. Can you believe that you and I have been talking roughly, what, 45, 46 times a year for 5 years? It's been crazy.
It has been. It has been. It's been great. I'm really happy to keep doing this with you.
Oh, absolutely. The audience loves you. Folks, remember, because we are in school, you can either A, raise your hand and I will call on you. You can ask Anna a question. If you're a little shy, you could put your questions in the comments and I will simply read them. Again, the sooner you get your comments in, the more likely I will get to them because I'm very democratic. I go top down. The first question gets asked first and on and on. So put your comments in, raise your hand, whatever you would like. But Anna, let's start. Was a wild start to the week. All right, the stock market was down big, crypto was down big. Talk of the carry trade unwinding, a very weak jobs number on Friday, rates crashing. Where do you want to start in all of this? What caught your attention?
It's interesting because last week you asked me, what's the probability of a rate cut at the end of July? And I said none, unless we get a suddenly unemployment rate report that goes up, or we have a crisis. And then that might, cause the Fed to cut earlier. So it was interesting that we finally got that uptick in the the unemployment report, going from 4.1 to 4.3, which doesn't seem like a lot. But you and I've been saying for a while, we've been tracking, about 60% of states had been in recessionary territory, for several months now, since May or June. And so it was just a matter of time before the official unemployment reports really ticked up. So it didn't surprise me that we finally saw this larger number. It did surprise me how quickly the market reacted to that with negativity. With that said, I think that the market's finally realizing, okay, Powell's holding too long. They were banking on a July cut, a lot of them. And then when they saw that unemployment number, like days after Jerome Powell said, employment's fine, job market is still fine. It's like
Mhm.
that dichotomy of it's fine, and then they didn't cut, and then, oh no, it's not fine. It's worse than they thought it would be. Not only worse unemployment, but worse number of new jobs created. And so I think the combination of that made them say, oh my goodness. At the same time, Iran threatened to go after Israel. And so
Mhm.
anytime you have uncertainty built upon uncertainty built upon uncertainty, at some point markets are going to panic and say, okay, we're not comfortable with the level of volatility. So I really think at a high level, if it had just been the unemployment print, there wasn't a lot of other volatility, I think the markets would have just absorbed it and say, okay, they've got to cut in September. But I think that combination of things, as well as, what happened with the Japanese yen, which a lot of investors really watch, I think it's that combo that's making the markets really uncertain about how much uncertainty is there left, even more so than should the Fed have cut already.
Yeah. It's funny that, the yen carry trade is it might be the most popular trade out there right now, at least with the most leverage. And it's really simple, right? You borrow yen at 0 and you invest it somewhere else at 5 and you make the spread. And the Japanese have raised interest or yeah, raised rates ever so slightly. But
Right.
apparently that was enough to prick the bubble. And I don't know if you saw this, but Jeremy Siegel was all over the news yesterday begging the Fed for an emergency rate cut. What
Yeah,
people don't realize is if the US cut rates, like he said, 75 basis point, that would actually be counterproductive. That would force the carry trade to unwind even further. And
absolutely.
it's crazy to
Yeah, I agree with that. I was kind of surprised that he came out and said that because, Jeremy's a pretty smart economist, and I've agreed with him on a lot of different things. But the reality, and I made a post about this actually this morning, for anyone that does follow me on Facebook, feel free to go read it if it's helpful. But essentially talking about, should the Fed do an emergency rate cut? And what we've talked about, I think we've talked about it on the show maybe last week or the week before. But essentially, historically, when you have an end of a cycle where you've got, some softening, it's clear that you're starting to contract and you start to see unemployment start to tick up just a little bit. Usually the markets don't panic until the Fed cuts rates. So historically, you have signs of recession, they start to build, but once the Fed actually cuts rates, they're admitting the economy is weakening and therefore recession's probably on the horizon. And that's when the markets go, oh my goodness, they actually cut rates. They see what we don't, and now we need to start selling. And so that starts kind of slowly, and then it kind of self-perpetuates and it creates this doom loop. So
Mhm.
the Fed's reaction says to the markets, we are a leading indicator, right? The Fed and
Right.
what they do is supposed to be a leading indicator. They're supposed to be ahead of the curve, not reacting to data like they have been lately, but I digress. So usually when they cut rates, that is the signal that immediately makes the markets react. This time, the markets are reacting in advance of the Fed cutting. And so if the Fed came out and said, oh no, the markets panicked. We had an uptick in unemployment a couple days after we said that unemployment was fine, they basically put back in the Fed put. And the Fed
Mhm.
put is what Jerome Powell has been trying to break. So
Yes.
historically, every time the market has a little temper tantrum and they
Mhm.
start to have a day or two that's off, the Fed comes in and they cut rates, and they do something to backstop something else that's breaking. And it basically is done to save the stock market. Well, Powell has been very clear that he is not listening to the stock market, that his goal is to get health in the financial system. And I think I talked about this last week as well, he wants to break the shadow banking system. He
Yep.
wants all the bad bets, whether it's loans or equities, to fall out,
Mhm.
to wash the slate clean like recessions kind of do. And then he'll have a legacy of having broken the zero bound interest rates, which stoke asset values and cause big crashes, having stopped the Fed put, and having really broke inflation. And so I think the worst thing that he could do is listen to Jeremy Siegel and do an
Yeah.
emergency rate cut. Even though I think he's behind and should have cut, now that the markets are panicking, if he does that, I think it's going to cause much deeper market panic, much greater sell-offs, and that
Mm.
creates that doom loop where businesses lose trillions of dollars in equity in days, which they've already lost a ton in the last 2 days. Then they start to lay off. Then the layoffs make the consumer nervous. The consumer, who has a lot of money in the stock market, more than they ever have been, in the past, starts to panic sell out of their 401ks. They stop spending because now they're really worried. And then that really deepens the recession. So I think that Powell will hold off till September unless the market rout is so terrible and the economic data that comes out this week is so much weaker than what they anticipate. Then I think he's going to have to, because they're going to try to stop the bleeding and stop that doom loop from happening before they even cut
Yeah.
rates. So yeah, he's in a precarious situation because they waited too long to lower rates. That's the reality.
Yeah, it's really fun watching because again, I've always tried to help people understand the Fed has, their every 6 weeks they meet, they do their decision on rates, but between those meetings, they get in front of the press, and it's always fun watching their kind of talking points. So I have
Yeah,
two that I talked about this morning on the daily financial news. First was President Goolsby.
yeah,
Goolsby had two lines that I thought were interesting. The first one is, basically, hey, I just checked our Fed mandate, and it's not my job to keep the stock market happy. I was like,
right.
oh, I like that one, right?
And that, to that point, that is what Powell's been saying. Like, they want to end the Fed put. And the fact
Yes.
that he came out and said, hey, I don't like being elevated and restrictionary into a weakening economy. He said that earlier
Yep.
this week. But to then come out and go, we're not here to make the stock market happy. To me, that signals, he knows what he's saying. And yes, he
Oh
doesn't
yeah.
speak officially for the Fed, but that signals to me they probably knew this could happen,
Mhm.
and they are going to hold strong and get rid of the Fed put.
Yeah, it's been. I think we talked about this way back at Jackson Hole that Powell was playing for his legacy, right? He's already got enough
Yes.
money. He's already got all this stuff. He's playing for the history books, and breaking the
Yeah.
Fed would put him on a Mount Rushmore of Fed presidents. That's where he wants to be,
Right.
right? He wants to be up
That
there
and
with
not
Volcker.
going back to zero bound. So
Oh
when he
yeah.
does cut rates, he doesn't want to take them back to, a quarter. And he
Mm-mm.
won't unless, if Iran attacks Israel like they say they're going to, and that really starts to escalate, things could get so bad that he's got to go back to the zero bound, but he will
Yeah.
do it dragging, kicking, and screaming. And I think that he's going to try to say, we're in control. We're
Mm-hmm.
going to cut in September. We're not going to give you the 3/4 of a point or the point that everybody's now hoping for and
Yeah.
pricing in. We'll give you 50. And then maybe, they give another 50, if things continue to go bad. But I think they're going to have to cut drastically at some point, but I think he's going to do it as slowly as he possible can. And then he'll have the legacy of, I held it long enough to break recession. I wasn't an Arthur Burns. It didn't come
Mhm.
back. I'm sorry, inflation, not
Right.
recession. And I broke the Fed put and I didn't go back to the zero bound. And I think that's his legacy, as well as letting the fallout happen to the shadow banking system so they can come in 2025 and finally
Yeah.
start regulating it.
I agree with all of those, and that's the game he's playing, right? He's playing a much bigger game, frankly, a more important game. If he's able to accomplish all of those, it will be net positive, um, going forward, because part of recession is a cleaning function, and he
Yeah.
knows that the shadow banking and the lending and all of that, there's some losses, there's some pain that has to be felt, as
Yeah.
opposed to another bailout. So I think that's pretty
And I think he
interesting.
can come back, when questioned later, why did you let this happen? Why did you let a recession happen? I think he's going to come back and say, I've told you from the beginning, it's
Hmm.
possible that the job markets will weaken. We need them to weaken. He said that, many
Hmm.
different times. Um, However, we had enough problems that these other problems were more important than not letting us have a recession. We hoped for the soft landing, didn't quite come. Lots of things happened that we didn't expect, like, all these different wars and,
Hmm.
political candidates being almost killed and, swap out of a president, all these things that he can say happened that they didn't
Yep.
see kind of exacerbated the recession. But I think if he came back and said, oh, I got rid of the Fed, I didn't get rid of the Fed put. I did go back to the zero bound. I did have a major recession. He wouldn't have any excuses for those. But if he
Yeah.
just lets the recession happen as a normal part of the business cycle that they said was a risk from the beginning and it just
Mhm.
materialized, but he did all these other things, his legacy's intact and he'll write books about it and people will call him
Oh
a
yeah.
hero years from now.
Yeah. Yeah. Generations of, his kids he'll be remembered fondly if he's able to
Yeah.
do all of those. The other Fed president that spoke that I kind of noted on the daily financial news was Mary Daly, Fed President Mary Daly from San Francisco. She was out talking about, yeah, the job market is weakening. Uh, and then she said the line that I thought was really interesting. Uh, we could start cutting in quarters from now, not months, not weeks,
Mhm.
quarters.
When
So
did she
again,
say that? I haven't heard her yet.
yeah, she said that yesterday, so I noted it yesterday.
Okay. Even
Yeah,
after the 2 days of
yeah,
market meltdown,
yeah, she
right?
said
So
it
there's
yesterday
another one.
afternoon. Yeah. So again, I think it's really interesting because the market is already pricing in 100% chance of a rate cut. I didn't check this morning, but yesterday it was like 80% chance of a 50 basis point cut, with some even betting on 75. This is in September, not emergency.
Right.
Um, but are you to the point where you think a September rate cut, at least a quarter point's a lock? Is that where you are?
Yeah, I would say they if I had to guess today, I would say that they cut 50 basis points, but they wait to September. Again, there's all kinds of things that could make them finally capitulate and say we have to cut before September. Iran going after Iraq is the thing. I'm sorry, going after Israel is the thing that really is on my radar because it
Yeah.
impacts oil prices and actually oil and commodities have been hammered the last couple of days as well because of the fears of recession that people will use less oil, et cetera. But if you've got this escalation in the Middle East, which it looks like it might materialize, that could cause a lot of pain. And so I think if that happens and it's bad, I think war, along with stock market meltdown, along with unemployment all ticking up, is going to be enough that they say there's too much weakening all of a sudden and suddenly, along with the political uncertainty that's coming, and curiouser and curiouser by the day. I think that there are scenarios playing out that could make them say, we wanted to hold off, but we felt like we had to because of all these things beyond our control. The other thing, that I'm watching, and I'm not an expert on this, so this is just me, thinking through and processing without any expertise on it. I mean, I have been in private banking and I've been in institutional investing as my corporate career before I retired 5 years ago for 20 years. So I know more than most, but I don't know than your average investor, right? But I don't know the intricacies. But I read a book I actually recommended on the show about a year and a half ago called Global Shocks. I don't remember who wrote it, but it's a really interesting read. And it's written by a guy who either worked for the Fed or the Treasury for a long time. They've been in government and politics, financial politics, economics for a long time. And they talked about all the kinds of global shocks that impact economies and how the US has reacted to them. And one of them is the currency war. And we've talked a little bit about it over the last couple of years as we've seen the US dollar becoming stronger or weaker. When the US dollar is strong, it's actually not great for our economy because it makes the cost to export things higher. So people in countries with a weaker currency, it costs them a lot more to be able to buy American goods. But we've seen a lot of strengthening and weakening of the dollar. We've been kind of the cleanest dirty shirt in the pile of dirty shirts economically, so still stronger than a lot of countries. But what happens is when you start to see trade wars and currency wars spike trade wars, and countries will react and do things to their currency to get an upper hand in their economy based on the net imports or exports and what fuels their economy. And so when I saw the yen do what it did yesterday, I thought this could be a very strategic move and a currency play, and it could impact trade. And the reality is, historically, there's multiple times in history. Again, I can't quote exactly when they were. I know in the 70s during the Iran-Contra, all of that kind of stuff, or wars with Cuba and threats of war, and under Kennedy, there were some currency wars. But essentially, the Fed can react and do what it needs to do to rates to strengthen or weaken the dollar just because of what's happening to other countries and their currencies and what they're doing to battle us for the trade and upper hand of the currency. So that's another thing that I'm just kind of watching and going, okay, the Fed may react if there's a currency war, or let's say Iran goes after Israel. And then we start to see that coalition of Russia and China coming on the backs, going after Israel against the US and our allies. They can start to do some things with their currency that could make us react just because of that, not so much because the market is melting down or we have a recession. So I'm just kind of watching and understanding that our economy is really complex. It's much more complex than most people think. It's not as black and white as, I know we opened the show with me saying history shows that,
Huh.
the market's going to panic once the Fed cuts rate. It's not quite that black and white because there's always these external factors that happen at the same time that could make the Fed and the Treasury react in different ways than what we think is going to happen based on history. So I know enough to say that I don't know enough to say, is there anything that can cause the Fed to cut rates before September? I think there's a lot of things that can cause them to do it. I still think it would be a mistake based upon what I know today. But we'll see. We'll see.
Yeah. Yeah, folks, remember you can either raise your hand or put questions and comments below. I will get to those when you have them. Lots of you have always wanted to ask Anna some questions, so this is your opportunity. Raise your hand or put comments below, but we will just keep going. Anna, one of the things that I think is pretty interesting is I think this election cycle, more than most, is really going to cause the consumer behavior to contract. Right, I called it a month ago probably that I think this is really going to be the start of the recession. I said it'll be backdated to June or July. A lot of that is because of the election cycle. We're hearing more and more people say, "I'll just wait till after the election to write an offer on a home." Right, do these things, probably buy cars, things of that nature. Um, do you think that still holds? And that's even without the Iran Israel conflict. I just think the consumers in mass, like, hey, too hard. I'm scared. I'm pissed off. Whatever that emotion is, they're just going to contract for a little while. What do you think?
Yeah, I think that's already been happening, you know. So when we talk about why I've thought that the recession technically should be backdated to the fourth quarter of last year based on lots and lots of employment data, a lot of leading economic indicators that actually were in the recession warning zone for several months. The reason that I thought it should be backdated is because all those things were already happening. It just
Mhm.
wasn't public data. It's not the headline data that was announced. But if you went to the conference board and you looked at the Fed, the Dallas Fed, and you look at their leading economic indicators, you can read in their own words that the economy is softening, it's weakening, a recession is very close. We have recession warnings, but then they come out in their press release and say the economy's strong, right? But the reality is, I've been saying for a while, when we talk about what's going to happen to the housing market,
Mhm.
are prices going to go up or are prices going to go down when rates fall? Where's there going to be demand versus supply? Now, when rates come down, for example, you might have supply increase because sellers are willing to move and find another house with a lower interest rate. But my worry has been the consumer and whether their demand is actually going to really come back the way it has, because they have been through 4 years now, Michael, of surprises and things
Mhm.
that they couldn't have anticipated, from COVID to the helicopter money to the housing market to the stock market to Russia going after Ukraine and Hamas going after Israel, to all the things that have happened politically. It's just so much uncertainty and things they never thought could happen that I think over and over and over they've been disappointed, especially if they've
Mhm.
been trying to buy a house. Whether it's on the credit side or whether it's the supply and demand. Investors who have invested as limited partners in commercial real estate have been wiped out. We've seen Ponzi schemes. We've seen, you know, what is it, FTX? We've seen all kinds of things happening. And at some point, consumers who are living check to check, last number I saw official was 66%. That's 2 months ago. Living check to check, credit cards already maxed. We know that 70% of travelers say they live check to check, but yet they're putting their summer vacation on credit cards. So we see that weakening of the consumer and kind of this volatility of the VIX and consumer confidence. And I think at some point, consumers go, okay, things are not getting better. No matter if everybody tells us the economy's strong, I'm feeling it. I'm hurting. My auto loans are going in default. My interest rates are going high. I can't tread water. They're taking on 2 or 3 part-time jobs. Once that happens to the consumer and all those things have happened, at some point the consumer breaks, and anything that doesn't go as they expect, any other unexpected, black swan event, is enough to make them go, I'm out. So
Yeah, I'm
I
done.
think even
Yeah.
without all the stuff that's happening politically, I think consumers are already there. I think what happened, with the assassination attempt and then the swapping of, Biden to Harris, I think that just breeds even more fear on top of fear already. And it might be the straw that breaks the camel's back. I think they're already broken. I think the consumer's been tapped out. And so it doesn't surprise me, especially now seeing the stock market, that they would say, I'm not going to buy a house for a while. Let's see what happens, because there's a lot of fear. No matter who wins, what will happen? Is there going to be riots? Is it going to strike up a civil war? Is anyone going to believe who won? You look at what's happening in, I think it was Argentina, and the election there. It might have been Venezuela. I might have them backwards. I'm sorry. But, I think the consumer has had enough uncertainty, and I don't think they come back as rapidly to buy houses and, have pent up demand as we think. I think the top 20% who are wealthy and still doing fine, they're going to still buy houses. The upper end's going to do better than the lower end. But I think the consumer is broken. And I think once you have an official recession, that's when their real fear comes, no matter who's in the election. And they say, I might lose my job. I can't afford to move. I can't let go of a down payment and closing costs. And I think it's going to be a while before they really start coming back in droves. That's just my prediction. I hope I'm wrong, Michael, but
Mm.
I think the consumer's broken.
Yeah. It's going to be really interesting to watch because, again, I had that thinking about the consumer and, again, transactions breaking the bottom, which currently is 3.88 on existing home sales. I think we go below that in July when those numbers come out. But we've also seen a 1% drop in interest rates, right? They've gone from roughly 7.5 to 6.5, right? One of the outputs or outcomes of all of these, rate cuts are
Yeah.
coming is we've seen a meaningful drop in interest rates, right? Yesterday was a 52-week low for interest rates, right? And, you know, I've often wondered, even on this show, talking about where's the marginal demand? And to your point earlier, where's the marginal supply? So let's play with that a little bit. I think marginal demand's a little easier because it's just math, right? A 1% drop from 7.5 to 6.5 gives the buyers 10% more purchasing power, right? Either
Mhm.
they could buy a house 10% more, or they could save roughly 10% on the mortgage payment. That's meaningful, right? Also, you and I both know for the last 3 years, one of the hardest things to do was to buy an entry level house. Well, inventory is up 40%. Um, Now we are starting to see days on market, go north of 40. I think at some point we do get a slight tick up in marginal demand, but I think a lot of people, to my earlier point, are like, dude, I'm going to wait till after the election. I'm in no rush. I'll wait till
Yeah.
next season. What do you think of marginal demand?
Yeah, a lot of it depends on how educated your home buyers are. When it comes down to it, I think most home buyers, whether they're educated about it or not, they don't know where things are going to go. There's been enough news that says we might have a softening and the Fed's going to cut rates. So I think they're hoping that the Fed cuts rates. But if they already own a home, right, that's a different segment of the consumer than those that want to own a home but don't. Let's say they're renters, but let's just talk about those that own a home,
Yeah.
right?
Okay.
um, they're looking at their mortgage payment, and we know 75-80% have mortgage payments that are much much lower than what they are today, right?
Yeah.
They've got rates between 2 and 4. I think it's
Mhm.
80% or under 4. Am I right? Or is it 80% or
Yeah.
under 5? But
Yeah.
somewhere between 75 and 80%. So even if they see a 6 handle, it's still going to cost them a couple $100 more a month to go buy a new home compared to their current mortgage rate. They're not looking at, oh, rates came down and I can save 10% versus yesterday. They're looking at their mortgage statement and saying, I'm paying $2,200 a month. And if I buy a new house today, by the way, any house I buy today is going to be more expensive than the one I'm in because home prices went up. But my mortgage payment's still going to go up $500. I think most of them are going to go, I can't afford to have my
Yeah.
mortgage payment go up 500. And to buy a new house, they're going to have to come up with closing costs. They're going to have costs to sell their home. They're going to have costs to buy their home. And what we've seen is that the savings have been depleted. The COVID era helicopter money savings have been depleted. So the average American has less than $4,000 in their checking account, in their savings account, right? Now
Mhm.
they're seeing their 401k money that they might have wanted to borrow against come down. I think they just look at the math and go, I still can't afford to move until rates come down meaningfully. And I'm
Yeah.
saying, post recession, and we might not have that long to wait, but I think until rates get in the like 5% range, I think they've got to be at 5 or lower to really start unlocking some of that marginal demand for the average homeowner.
Yeah. That's where I was going to go next, marginal supply. And I think you're absolutely right. I think rates falling from 7.5 to 6.5 will get some marginal demand off the sidelines, right? The top 20% who's been shopping for their entry level home. Maybe they're an Nvidia employee or something. They've got stock money. So I think some demand comes back. But to your point, it does nothing to unlock supply. You're not going to go
Right.
from a 4 to a 6.5. The move up buyer, which I've been talking about for years, is out. They're broken. And
Yeah.
until the move up buyer is back in a meaningful way, the housing market's just going to continue to be broken. And I totally agree with you. I think the magic number is 5%.
Yeah.
I think
It's got to get there to unlock a meaningful amount of supply and demand, because a
mhm.
lot of those homeowners they're both the seller and the buyer.
No,
So
yeah,
they
they're
got to
two
be motivated.
transactions. Yep.
They
Yeah.
got to be motivated enough to get out of their current home, find something if they can from the limited supply that's out there now, and even if that upticks, that they're reasonably going to be happy living in compared to where they are. And a lot of people remodeled their homes already too, so they've
Mhm.
already got the house that they wanted with the rates that were really low. So they've got to be able to find something they like just as much and sell their home for top dollar and get that lower interest rate. And I'm somebody that's in that top 1%, and I'm very very grateful. But I've looked at my house and I've seen a couple houses come on the market that I've said I'm never moving again, ever ever ever. But I've seen a couple houses that I'm like, Oh, that's really nice. And then when I look at my numbers, I'm like, that would be so stupid, like so stupid, right? Why
Yeah.
would I ever give up a 2 point, I think my house is 2.3% or
Wow.
2.6%, one of my houses. And so I just, it wouldn't make sense.
Right.
I think the average consumer who again, about 65% are homeowners and about
Mhm.
66% or more are living check to check. So you've got to take those things together and
Mhm.
say the average homeowner is living check to check. That average homeowner's cost of living has gone up 25% in
Mhm.
4 years since they got that low interest rate. It's going to take a lot for them to go,
Oh, for sure.
okay, um, I can make that move and not think that it's stupid. So I don't think you're going to have this mass increase in supply and a mass increase in demand that's going to turn you into a buyer's market in most markets for months till you're on the other side of a recession being called. I could
Yeah.
be wrong. And here's the thing, you and I talk about this a lot, but I just feel like you gotta like hit the nail on the head a zillion
Mm.
times, right? Is every market is so different. And it really depends on supply and demand in your market,
Mhm.
how strong and resilient your market, your local markets are. How many employers are there? Is it going to be a GM like situation in Detroit where one big employer goes under during a recession and everybody loses their jobs? That makes a big difference. So if you're in a market and you invest in markets where there's a really resilient, broad employment market, lots of different industries, lots of different sectors that aren't all hit hard at the same time, and you have a lack of supply and people want to keep moving there for jobs, you're going to do really, really well if you're a seller,
Mhm.
and you're going to have to pay a premium if you're a buyer. That's different for different markets. And so it's really hard to make a broad sweep comment about what's going to happen in the housing market when it really is hyper local and dependent on the resilience of your market and the supply and demand that's there.
Yep, totally agree. We're going to go to the questions now. Just again, if you want to put your questions in the comments, I will read them. The first question from Catherine is about your book. I looked it up. It's Global Shocks by Nicholas Sargent. Hopefully, I got
That's
that
it.
right. I'll put a link in the description, so if you want to click on it, you can. So yeah, Global
Yeah.
Shocks was the book. Now we got one from Trade Better. Um, what were your feelings about the folks in Europe? You just got back from a journey with your kids. What'd you think about Europe?
It was amazing. We had a really great time. It was very, very busy. Lots of people shopping. I did notice, I went through France and Italy and Spain and, a lot of boutique shops, but a lot of very, very high-end, stores as well. Versace, Dolce and Gabbana, etc. There were a lot fewer people in those very high-end stores. Tiffany's, no, I mean, I peeked in the windows. Even though there's a little piece of me that was tempted to like, let's go in Tiffany's and France and buy something. I didn't do it, right? Because I know I don't need it. It's not going to make me happy and yada yada. I can buy cheapies, online that look just as good. But it was interesting because I did pop my head in some of the windows and there were not people in most of them and they had security. So the really high end, I think the consumers are smart enough to go, I don't need it. I'm not going to buy it. Not today. Right.
Oh yeah, absolutely.
However, there were lots of people on vacation, lots of people eating at expensive restaurants, lots of people, shopping throughout. And so I think that it was kind of evidence of what I see in the United States. It's a bifurcated world, and the top have gotten wealthier, and they're going to continue to spend because they've built up the wealth and the income to be able to do it, right? But I think most of the people who are traveling are either in that top end and saying,
Yeah.
I can afford it, I'm going to do it. And this might be my only chance to do it for a while before the economy gets worse. I did it. I planned it last year. I knew it was going to be an extremely expensive trip because there's six of us, right? And it wasn't cheap. But I said, this is a once in a lifetime for my family that I'm going to spend a lot of money and I'm going to do it. It's going to be worth the memories that I make. But I'm only able to do that because I had years and years of savings and living below
Hmm.
my means. But you look at the fact, and again, I'm going to keep coming back to 66% because that's the last official number that are living check to check. They shouldn't be traveling, but they are. The survey that we talked about just before I left said 70% of those traveling
Yeah.
say they live check to check. They're putting their trip on a credit card, but they're still going to go do it.
Mm.
So just because I saw lots of people out in Europe traveling and shopping doesn't necessarily mean that that's a good economy, that Europe is strong. It's mostly foreigners coming to Europe. Um, and they're going to travel. It's kind of like, I'm going to do this because I want to make memories, even though everything else is kind of going wrong in my world for a
Hmm.
lot of different people. So if you're just basing it based on how many people are in Europe and shopping and eating, you would think the world's great, everything's
Hmm.
fine, just like the news says it is. But the reality is, there's a deeper picture that you got to look at the data and see that wealthier people will always continue to travel. And in fact, if you look at the second quarter GDP, because most people are prepaying for their trips, like you got to buy
Hmm.
your tickets in advance, you got to buy your cruise tickets in advance. They prepaid probably the last, the second quarter, then they went on their trip. And so if you look at GDP, that print that was over 2% that kind of surprised people, it was all government spending, healthcare costs, housing costs, insurance costs, utility costs, and luxury travel spending.
Hmm.
Well, they still spent. That doesn't mean that the consumer's healthy. It just means that they put it on their credit card and went anyway. So
Yeah.
that's just my general view of what I saw in Europe, and why I think that it doesn't necessarily mean that the economy is healthy overall.
Another question from Trade Better was, have you ever thought about purchasing real estate abroad, like out of the country?
I have. And in fact, I thought I would look at some stuff in Spain and in Portugal. To be fair, it was so hot. And I mean, I'm from Texas and I've never been so hot. But
Yeah,
you
it's
go
hot out
from
there.
7 a.m. to 7 p.m. on cobblestone streets up and down,
Yeah.
from mountain down to the ocean over and over again. By the time that I saw stuff, I'm like, okay, there's real estate for sale. I'm too tired to even look at it. I have thought about, I'm not a doomer. I'm a optimist, and the world always seems to figure things out, right? But I have thought about for several years, but never acted on it because it tells you I'm not that serious about it. But I've thought about, if I ever wanted to leave the United States and it got bad enough, where would I go? And Portugal has been one of those countries who has like this golden visa program that if you buy a property there, you have it for so long, you invest in a business, you can get a dual citizenship at some point. So I thought about it, but at the same time, I know what I know really well. And after buying investment property, vacation rentals, for example, in states that I don't live in, and seeing the volatility there, the reality is it'd be very, very difficult for me to manage well a property in another country that I don't understand. I don't understand the rules. A lot of Europe is really starting to crack down on short-term rentals and starting to ban them completely. And there's just not enough. If I was going to be going to Europe like at least 2 or 3 times a year, I might do it. But for me, there wasn't enough meat on the bone. It wasn't like a grand slam reward versus the risk of having a property in a country whose rules and economies and laws I don't understand, and especially going into what I believe is going to be a global recession. And so I just didn't think the time is right. Will I do it in the future? Maybe. When there's blood on the streets and there's a deep, deep crash at some point, maybe this year, maybe 10 years from now, I don't know. If the geopolitical stuff is good enough, I might buy a property in another country. I've really thought about it, but just not compelling enough to me with all of the world uncertainty and where I think the economy is headed for at least, at best case, a flat decade.
Yeah, love that. Love that. Question from Paul. First and foremost, Paul, congratulations to you. It looks like you're retiring in 2025, January 2025. That's right around the corner. Congrats. Paul's question is, hey, basically he knows single families. They own 22 of them at this point. He's wondering, given that he's going to retire in 2025, should he stay in his lane with single families, or should he open it up and start to understand the multifamily dynamics, given what at least I think is coming in 2025, some significant pain. Given what you know here on it, what would be some advice for Paul, perhaps?
Yeah, first of all, congratulations. Your retirement is within view, and I know exactly how that feels. It's exciting, but it's also scary. And when I first gave my notice, I mean, I had been working for 10 years to get to that point when I was really ready to give my notice. I was like paralyzed with fear. Like, what am I
Uh-huh.
doing? Is this the right thing? I have a six-figure job. I have a great job. What am I doing? Is the economy going to crash? And when I gave my notice, when I started to prepare to give my notice, it was December of 2018 when I did my first larger multifamily deal, and we had a manufacturing recession, and we had a market temper tantrum, right, in January of 2019 that caused the Fed to react and lower rates. And so I was starting to question, where's the economy going? And look, we're 5 years later, and the economy's okay-ish,
Mhm.
but heading into a contraction. So with that said, um, don't don't make any big decisions that are big change between now and a few months after you retire, because you will not be at your top. You'll second guess everything you're doing because suddenly you're moving from that secure paycheck to now you're on your own. And so just be really careful not to shift gears and make big decisions and put big money onto something new, or to totally try to change everything. This isn't the time in the economy to do it. So not only is it just dangerous to make big life-changing, big money decisions anytime you're going through major change, which is like death, divorce, job change, retirement, moving, those types of things. You also want to look at the reality that we're on the cusp of a deep decline economically. And so you've got to understand that anything you invest in, the income and the asset values likely are going to fall over the next couple of months to year or two. And a recovery usually lasts 2 to 3 years beyond a recession once it's over. So you're going to have probably, I would say at best two, at worst, maybe 4 to 5 years of somewhat depressed values and income. Now, the good thing as investors, we want to be opportunistic. So it's also the best time to make generational wealth is when you buy at the bottom. But when you buy something that you understand to some extent, you're going to make better decisions because you're an educated buyer on that regard. And so if you own 22 single family rentals, if you see good deals that look like a good deal to you, that meet your number one investment goal. And again, I always put back on my private banker hat and I say, it's not about the building. It's where are you today and in the next 5 years, and what's your number one investment goal? Is it you need more income? You want more equity and appreciation, or you're in wealth preservation mode? And depending on what you've built up to prepare for this retirement, your answer might be different. But let's just pretend you want more income. Okay. You're giving up the check. You've had the 22 rentals and now you want more income from the rentals. Only do deals in the markets where a good deal is and what a good deal looks like. And only do good deals or great deals. Don't do anything mediocre. So
Mhm.
I would first start with sticking with your single family and looking whether you can find those types of single families where you've already had success before you move up to multifamily. With that said, I love small multifamily. Small multifamily, one, duplex, triplex, quad. If they're in your market, find the biggest of those you can. I made my wealth with 4 unit apartment buildings because they were all over my local market. There weren't duplexes and triplexes, not many, but there were lots of 4 units. So if you have 4 unit buildings, you can get residential loans that you can lock for 30 years. So the thing that I love about small multis is you can lock those rates for 30 years. And if you're buying in a recession with values that hopefully are at least somewhat depressed, depending on your local market, and you can get a DSCR loan and lock that low, historically low interest rate for 30 years, you're going to be really happy. You're going to cash flow better over time. They're going to appreciate, and you're going to be really happy. There's a lot more risk with multifamily. And yes, there is huge opportunity because multifamily is already down 20 to 40% across the country, but you need millions and millions of dollars to take it down. And unless you've got millions on the sideline and teams and partners who have extensive experience, I'm talking 20 years experience, you're setting yourself up to make some life-changing risk, to make a bad bet that's not going to cost you a couple $1,000s or 10,000 on the bad bet, but a couple $1,000,000. And so I would say bigger is not always better. Trust me, I've invested in everything up to 500 unit apartment buildings. And my biggest pain right now is my almost 500 unit apartment building and a 400 unit apartment building, because interest rates are out of my control. Insurance and taxes are out of my control. So both my income, my net income, and my cap rate, the denominator that determines the value of that asset, are really stretched. They're really significantly challenged, and it's hard to get those through. And you have investors. So if you don't have experience working with investors, and you don't have enough confidence in doing that deal that you can put investor risk at money, I say don't play in that game for a while. Let the big guys play. And if you want a piece of large multifamily, invest with a syndicator like myself. I haven't done a big deal in 2 years, almost 2 years, because there hasn't been anything with a good enough return for the risk that I have to take for myself and my investors in the large multifamily space. So that would be my advice. Stick to single, small multis, lock by as much as you can that cash flows with 30-year fixed interest rates, hopefully sub 5, and you will be happy. Don't let FOMO make you
Yeah.
think that bigger is better.
Yeah, that's kind of exactly my advice. If you already got something that's working, you're going to enjoy retirement. To me, that means you're not in massive growth mode. Just stick with
Yeah.
what works, right? Don't Bigger is not always better. In fact, I
Yeah.
think we have a lot of pain coming there. We have
One
one
last thing
brave.
I would
Oh,
just add to there, Michael, I'm sorry, just
sure.
for everybody, even if income is your number one or appreciation is your number one, everybody, I don't care who you are and how much you have, right now, asset preservation should be your number one, at least until we're on the other side of a recession being declared, the market falling the 35% that it usually does historically after a market crash. When we're on the other side of that, that's when you go, okay, the recession is definitely here. The Fed has cut rates. Things are falling out. This is where there's pain on the streets, blood on the streets, massive opportunity. Now I'm going to go in to try to buy that stuff to give me more income and appreciation. Don't do it between now and then, unless you've got a lot of money. I mean, Michael and I are still looking at deals every day, and I want you to look at deals every day. And if you find a phenomenal deal that's going to preserve your wealth and meet that extra income or appreciation, great. But
Yep.
don't bank on appreciation. It's going to take years to appreciate for most properties after we go through the recession or recovery. Make asset preservation really important. It's okay to be conservative, and this is the time when you need to be conservative until you know we're in a recession. Now, preserve what you got and work on your other goal at the same time.
Awesome. We got our first brave soul raising his hand, so we're going to call on Trade Better to ask his question.
Hey, thanks for taking my question. Anna, you have perfect pivot story for when the '08 crash happened and everything. So I guess because I, have loved ones, family, friends who are kind of in the check, would you speak to them without, I guess, being too preachy about wealth preservation and everything?
Yeah, it's really hard. It really is, because the reality is most people have never known anything different, right? I grew up in poverty, and I still have family who are in poverty and have poverty mentality, and I've tried to help them. I have a couple that have actually said, okay, first thing I did, love him or hate him, but I introduced them to Dave Ramsey, because their first steps were they need the baby steps. And yes, I don't take his advice always as someone who's already built wealth, right? Because I would do things somewhat differently. But for the average person that lives check to check, they didn't just suddenly become that way. Now, yes, they've had an increase of 24, 25%, maybe even more in their cost of living. So they're stretched even further than they were. But I would start out with they need to really get on a budget and not just say, oh, I'm on a budget, but really get on a budget and cut their discretionary spending. And the recession is going to force them to do that. They probably already had to start doing it because of inflation, but I would introduce them to someone like Dave Ramsey, who's going to really help them understand the baby steps of you will never get out of living check to check until you learn to live below your means, quit putting everything on credit, pay off your credit cards. Most people, I don't want to tell them to go buy an investment property that's going to make them 8% when they've got 50 grand of interest at 20, 23%. I want them to pay down that debt first. There's lots of ways you can get it at lower interest rates and whatever, but they have to learn the baby steps. So I would encourage them, and I've gifted my family members Financial Peace University by Dave Ramsey. I used to teach it at my church. Now it's been, a few years and he's changed his program and whatnot, but I would start there, because then it's a gift and it's like, hey, I've noticed that you're struggling. We've talked about this before. This is something that can really help you to just understand the basics of money and how to get ahead a little bit. And then once they have that huge credit card paid down, then you can start talking about them about investments. But the reality is most people, if they can invest in their 401k and dollar cost average and get that company match of 6% or 100% match for a lot of companies up to 6%, that's good enough for them to get started. But it's really difficult for people to internalize it until they take the first step to say, I know I have a problem with my finances. I know I'm never going to get ahead if I don't get control of it. And then and only then do you really start talking to them about, here's how you can make money in investments. Most people just look, 66% of the American households, and that's about a little more than those that own homes. They're already homeowners and they're already falling behind. And so unfortunately, it's only about the top 25% that even invests in the stock market, and invests in anything. So start there, help them, just get some basic financial literacy down. And then when they're ready, if they've got some savings or they've got maybe a 401k and they want to start, investing with that, talk to them about talking to someone about taking a 401k loan and whether that might be a smarter way to pay down their debt, and then start to maybe use some of their 401k to invest long term.
Yeah, one of the things that I would recommend, and I only recommend things that I've done, is really do an audit. Ask them to do an audit of their last 90 days of spending. And what I mean by an audit is what's a need versus a want. I think you have
Yeah.
to ask yourself honest discussions. I think you have to do it with your partner, husband, wife, girlfriend, boyfriend, whatever. You have to do it together because maybe what you think's a need, they think's a want. And you just have to start the conversation. And I totally agree. For most folks, Dave Ramsey, baby steps, home run. That's great advice.
Yeah. And
Excellent.
I did financial peace for 7 years. And if I had not lived well below my means for 7 years as we worked to pay off my husband's business startup debt, I never would have created the wealth that I did. I couldn't have done it. So, we did it. And it's story for another day. I think I did a show with Michael about it. But, when we got out of personal debt, we actually called Dave Ramsey and said, we're debt free. And then I said, okay, is it different? Is it okay to use credit cards or debt to go in to start a business? Because it's, everyone's telling me the economy's booming. This was 2007. And you have to spend money to make money, and we need a business startup debt. He goes, don't do it. This is not the time to start a business. And you do not go into debt to start a business. 95% of you are going to fail. Wait, work for someone else, save up the money, and then start the business. And I thought, I know better. I was in private banking and I knew investments, and we thought the economy was going to be great. And I didn't listen. And it cost me 10 years of my life because we started a business with 700,000 in business startup debt. So as much as, yes, there's things that I don't agree with him on, I invest differently today. Real estate is the way I made wealth. It's the way he started to lose wealth. If you're that starting off investor until you've created wealth, he has a lot of really good principles for you.
Yeah.
Great. Thank you very much.
Thank you. Thank you. Well, Anna, we're just about up at the 9 o'clock hour. What are kind of your closing thoughts for the group as we wrap up another week of conversations? What do you think?
I think the biggest thing right now, if there was only one other thing that I could add to it, is just to really remember, Warren Buffett just pulled out significant millions and millions, maybe even billion. I don't know how much.
$277 billion in
Billion.
cash.
I thought it was billion, but I thought no. But he just pulled out of the markets, and he has in cash, right? And one of his adages that's really resonated with me is to be fearful when others are greedy and be greedy when others are fearful. And so you are going to see a lot more negative news in the coming days, in the coming weeks, in the coming months. It's going to get worse. There's going to be more things that are surprising. And you have to have the wherewithal to understand the reality of history shows us that when things are really bad, it's the time for you to wait till it's clear that it's really bad, right? Wait till we're in that recession. But the time to realize that right when all your family and your friends and your investor friends who've been doing it, who are out, and they say, it's not working. Run away. What are you doing? You're an idiot. Why are you buying real estate? Real estate's crashing. The world is crashing. When everybody says that you're the idiot and they stop doing it because they're afraid, that is the time for you to run into the fire, because that is the time when you are going to make generational wealth. You've got to do it slowly and methodically and understand your market, understand what a good deal looks like. But that's when you go, and that's when everybody else is running away because your competition's out. Your sellers are more motivated. You've got really cheap debt to go buy properties with. So that's the time that you go in. So don't get afraid and more afraid when more scary things happen that seem to be outside of your control. But don't take action that's uneducated action and think that I can buy anything now because there's blood on the streets. You don't want to pick up someone else's headache and someone else's problem property that they haven't been able to make work. So be very careful, but be excited. I'm excited because finally I see all the signs are starting to really ramp up together and coincide that says, yes, the recession's here, and that's going to mean big opportunity for me. So do the work, keep listening to the show. We'll continue to, tell you what we think about, where we are. And don't go it alone. I went it alone in the beginning and I was a little gun shy because I lost so much in 2008, 2009 working for AIG that I was nervous, but I went and I took a leap of faith, even though I was afraid, and my life completely changed for it. So this is exciting. Watch what's to come. If you need you need someone to shake you and say, don't be scared. This is still a good thing to do. I can tell you that in all the years I've worked and invested in the financial sector as well as real estate, there is nothing greater than real estate to create wealth, to sustain wealth, and to grow wealth. There's nothing greater, not the stock market. I don't care how well it's done, in the past, but that you can also control and you can sleep at night knowing that it's going to be there for you in the future. So I'm excited. I hope that you're getting excited, and just hang on because it's gonna keep changing and getting even more interesting.
Anna, you're amazing. Thank you for being here. Thank you for being a part of school, sharing your wisdom, encouragement, thoughts. You are amazing. We'll talk next week. Take care.
Yeah.
Bye.
Take care, guys. Thank you. Bye.